You check your account, and the number you see is not your savings but your actual balance. $20,000 sitting there, and it took you years to get there. It is late at night, and you refresh the screen again, hoping something changes. Nothing moves, and the pressure stays exactly the same. This is not about money, at least not in the way most people think. This is about a decision that looks small but quietly shapes your future. Two people start from the exact same place. Same age, same city, same income, and same opportunities. $20,000 ready to be used. One decision changes everything from this point forward. Ethan decides to buy property because it feels real and secure. He uses his money as a down payment on a small rental studio. A simple studio apartment in an average neighborhood. A long-term mortgage locks him into monthly payments. A tenant moves in, and the rent starts coming every month. On paper, it looks like a smart move. In his mind, it feels like he just entered the real estate game. Daniel takes a different path that almost nobody notices. He invests everything into a total market index fund. No property, no tenants, and no keys. Just a number inside a brokerage account. People notice Ethan because his investment is visible. Nobody notices Daniel because his is not. This is where most people get confused. Visibility looks like success even when it is not. The first years feel good for Ethan. Rent arrives every month and confirms his decision. He tells his friends he owns property. Everything feels real and under control. Daniel feels nothing because nothing exciting happens. The number moves slightly up and down. No story, no validation, and no visible progress. This is where most people quit, because boring looks like failure in the beginning. But something is happening quietly in the background. By year 3, reality starts to show. Ethan has been collecting rent consistently, but costs start appearing one after another. Property taxes take a portion every year. Insurance costs add another fixed expense. Small repairs start to accumulate. A vacancy period removes income for a month. The profit he expected starts shrinking. The real cash flow is lower than planned, and this does not include time. Messages from tenants, small problems, and coordination. Weekend tasks that were never planned. Real estate is not passive. It only looks like it from the outside. Meanwhile, Daniel keeps doing nothing. And that is exactly why it works. His investment grows slowly but consistently. No calls, no stress, and no interruptions. This is where the difference begins. If you are still watching, this is where it gets interesting. Subscribe now and turn on the bell for more breakdowns like this. Back to the story because the key insight is coming. Ethan still has an advantage and it matters. Leverage allows him to control more than he owns. The studio value increases slowly over time. His equity builds with every payment. This is real wealth created with borrowed money, but there is a cost that never stops. Every advantage has a price attached to it. Maintenance continues every year. Some years are easy and others are expensive. A big repair can appear without warning. One expense can erase months of income. Managing the studio becomes a responsibility. Do it yourself and you spend time. Outsource it and you lose part of your income. Either way you pay. Tenant risk still exists even with a studio. One bad situation can change everything. By year 5, expectations shift. The returns are real, but not as high as expected. Daniel continues with the same simple strategy. Compounding starts accelerating quietly. The gains create more gains each year. Time becomes his advantage. By year 10, something surprising happens. The numbers start looking similar. Ethan built equity through effort. Danielle built value through consistency. The result is close, but the experience is completely different. Ethan worked for his investment. Daniel let his investment work. This is the real difference. By year 20, the gap becomes clearer. The studio is almost paid off. Its value has increased over time, but after all costs, the total gain is limited. Daniel's portfolio keeps compounding. Most of his wealth comes from growth. No debt, no tenants, and no interruptions. The final numbers are in the same range, but the journey is not. One required constant attention, the other required discipline. This is what most people miss. If Daniel invested more each month, the gap grows fast. Compounding multiplies everything. Real estate scaling means more work and more debt. Market scaling means consistency. Both have risks. Market crashes can hurt quickly. Real estate problems can destroy cash flow. The real mistake is choosing without understanding. Most people follow opinions. Very few run the numbers. The truth is simple. Wealth is built over time. Consistency beats intensity. And before you go, if this changed your perspective, hit subscribe and turn on the bell for more, because the next decision you make might change everything.